Welcome to the Deep Dive. Today, we're unpacking Signet Jewelers' Q2 2026 earnings call. We'll look at their impressive recent performance and what they see coming for the holiday season.
Yeah, we'll hit the key numbers quickly and then explore the strategies behind that outlook, give you the full picture.
Okay, let's kick this off right with the results, because Signet Jewelers, well, they just reported Q2 numbers that actually beat their own guidance.
Which is always a good sign, right?
Definitely. Total sales came in over $1.5 billion. That's a solid 3.0% increase compared to last year.
And it's not just the overall number. The really interesting part for me is the same store sales, SSS. You know how existing stores are doing.
Right, the core health metric?
Exactly. They were up 2.0%. And get this, it's their 8th straight month of positive comps.
8 months. Wow.
Yeah. And their big three brands, Kay, Zales, and Jared together, they delivered about 5% comp growth. That's the second quarter in a row for that kind of performance from the core.
Okay, so consistency there. And what about what people are actually buying? The average unit retail AUR?
Good question. That jumped roughly 9% overall, which is pretty significant.
9%. And how does that break down?
Well, fashion AUR was up over 12%, which is huge. Bridal AUR saw a 4% lift.
So fashion is really driving that average price point up. They're
Yeah.
selling more expensive pieces there.
Precisely. And these strong top-line figures, they really flowed through nicely to the bottom line. Gross margin rate expanded 60 basis points,
Right.
up to 38.6%. And that came from, well, two things.
Yeah.
Better merchandise margin and leveraging their fixed costs because of that 2% comp growth.
Makes sense. Spreading the costs over more sales.
You got it. So adjusted operating income grew more than 20%. That's $85.4 million. And adjusted EPS, earnings per share, saw a really robust 29% jump to $1.61. Which brings up a key point. How are they managing this profitability, especially with gold costs soaring? Gold was up over 30%. Right?
Yeah, it's a major input cost.
Yeah. But look at their inventory. It stayed flat year over year, around $2 billion. That signals some really tight, efficient management. They're not getting stuck with too much product, even as materials get pricier.
Shows discipline. And they're generating cash too, right? Free cash flow.
Absolutely. Over $60 million in Q2. That's almost $50 million better than last year.
And returning cash to shareholders.
Yep. They bought back $32 million in shares in the quarter, about 500,000 shares. Year to date, that's $150 million, or 6% of their outstanding shares.
And they still have authorization left.
Quite a bit. Around $570 million still authorized for repurchase. It shows confidence, doesn't it? They believe in the strategy.
It certainly does. Okay, so strong numbers. But how? What's the strategy driving this? You mentioned the grow brand love idea seems to be working.
I think that's exactly it. It's about more than just the core diamond engagement ring. You know, it's about fashion. It's about services.
Right.
And those are key drivers. Fashion comps up 2%. Services grew over 7%. But the really standout trend here, lab-grown diamond fashion, LGDs.
Yes. That's been a big topic.
Huge. Their penetration, meaning the share of LGDs in their fashion sales, it doubled from last year. Doubled. It hit about 14% of total fashion sales in Q2.
14%. So it's moving from niche to, well, pretty mainstream within their fashion offering.
It really is. And here's the kicker. LGDs aren't just replacing natural diamonds. They seem to be expanding the whole pie. People are buying more jewelry.
Interesting. Because they're more accessible.
Partly. But also, these LGD fashion pieces, they carry a 3 times higher AUR premium compared to other fashion items.
3 times. Okay, so that directly explains a big chunk of that overall AUR jump we saw earlier.
Exactly. It's a major boost to their average selling price and margin. And beyond the product itself, they're also getting smarter with pricing and promotions.
How so?
Well, look at Jared. They actually cut back on discounting by 20–30% in the first half of the year.
Really? Took a risk there.
Seems like it paid off. And Kay and Zales, they took selective price increases, mid-single digits on key items, key SKUs. It's a move away from just deep discounts all the time.
Focusing more on brand value, maybe?
I think so. It's a balancing act, but it shows they feel they have pricing power. But you need the marketing to back that up, right?
True. How are they doing there?
Pretty efficiently, it seems. They boosted brand marketing impressions over 40%.
Wow.
But on only a modest mid-single-digit increase in media spending. That's good leverage.
Very efficient. Where's that spend going?
A lot more into social media. Buys there were up over 20%, and social now makes up more than a quarter of their total marketing spend in Q2.
Makes sense. Meeting customers where they are.
Totally. Think about campaigns like Jared's Love Highway with Taylor Hill, or Kane naming Teddy Swims their chief love officer. It's about cultural connection, not just ads.
Right, building that brand love directly.
And they've brought in new leadership to drive this. Julie Jocham, new president for K& Peoples, comes from Helzberg and Blue Nile. Lisa Lachey, the new CMO, was at Crocs.
Crocs, interesting. They definitely know modern marketing.
Exactly. It signals a real commitment to modernizing the brands and boosting digital engagement. They're putting the right people in place.
Okay, so strong Q2, clear strategic drivers. Let's pivot to the future. They raised their guidance, didn't they?
They did, which is a confident move in this environment. For Q3 specifically, they're projecting sales between $1.34 and $1.38 billion.
And same-store sales.
Pretty tight range there,
Yeah.
down 1.25% to up 1.25%, and adjusted operating income between $3 million and $17 million.
Okay, so maybe a bit flatter in Q3.
Well, they do expect some SG&A deleverage, basically overhead costs rising a bit faster than sales temporarily.
Why is that?
A few things they called out: incentive pay resets, costs tied to their reorganization, and interestingly, shifting some marketing spend from Q4 into Q3.
Investing ahead of the holidays, maybe.
That's how it looks. It suggests they're willing to take a small hit now for hopefully a bigger payoff later, balancing short-term results with long-term strategy.
Got it. And for the full year, that's where they raise things.
Yes. Full year, they now see total sales between $6.67 and $6.82 billion. That's up from their previous range.
And same-store sales for the year.
Also guided higher, now expecting somewhere between down 0.75% and up 1.75%. Again, better than the previous negative 2.0% to plus 1.5%.
So definitely reflecting that Q2 strength and some optimism.
Absolutely. And crucially, the profit outlook is up too. Adjusted operating income raised to $445 to $515 million, and adjusted EPS guidance got about a 3% bump at the midpoint, now $8.04 to $9.57 per share.
Okay, so despite maybe a slightly softer Q3 expectation on margins, the overall picture for the year looks brighter.
Exactly. They're showing confidence based on Q2 and their Q3 plan, even calling out a, quote, measured consumer environment.
There's always a but, isn't there? There's a big external factor hanging over this.
Yeah, this is the curveball. India. It accounts for roughly half of Signet's finished goods purchases.
Half. Wow, that's huge exposure.
It is. And tariffs on those goods have just skyrocketed, from 10% to 50% in just the last 5 weeks.
50%? How?
It includes an extra 25% penalty related to Russian trade restrictions. So, bam, a massive cost increase hitting a huge part of their supply chain.
Okay, that's a major headache. How on earth do they manage that and still raise guidance?
It's a critical question. They have a multi-part plan. First, use existing inventory bought before the hike.
Okay, buy some time.
Right. Second, try to shift production to other countries, though that takes time.
Yeah.
Third, carefully look at pricing and promos. Where can they absorb it? Where might prices need to nudge up?
Tricky balance.
Very. And fourth, using bonded warehouses to delay paying the duty. But their guidance is now directly tied to this.
How so?
They basically said if this 50% tariff stays all year, expect operating income in the middle to lower end of that new higher range. But if the penalty part gets removed soon, say in the next couple of months, they think they can hit the upper half of the range. It shows just how much uncertainty that tariff adds.
Yeah, a huge variable. But despite that, they sound pretty bullish on the holidays.
They do. They use the phrase fully prepared and well-positioned. They're loading up on LGDs, men's jewelry, trending items, specifically in that $200, $500 gifting sweet spot.
Smart, hitting key price points.
And get this, they plan to more than triple the number of LGD fashion pieces under $1,000 for the holidays, and even bigger growth for items under $500.
Tripling down on accessible LGD fashion? That's aggressive.
It shows they believe customers will spend if the product and value are compelling, even in a measured environment. They're betting big on that category.
So specific products, smart pricing, targeted marketing. It sounds like a cohesive plan.
It does. Combine that with less deep discounting overall and the full funnel marketing push. It's a clear strategy to win the holiday season despite the tariff headwinds. And they're not forgetting digital either.
Oh, right. Blue Nile and James Allen.
Yeah. Blue Nile actually returned to positive comps in July, saw 25% growth in fashion in Q2. And James Allen's drag on comps lessened in Q2, and they expect it to lessen further. They're working on faster shipping and more ready-to-ship jewelry there, too.
So improvements across the board, really.
Seems like a concerted effort.
Okay, so wrapping this up. Signet delivered a strong Q2, beat expectations, raised the full-year outlook, and has a clear albeit challenging path mapped out for the holidays, tariff issues notwithstanding.
It's a complex picture, definitely managed, which leads to maybe a final thought for you listening.
Right.
You know, we look at jewelry, we see the sparkle, the finished piece.
All right.
But when you understand this whole complex dance behind it, the global supply chains, the tariff impacts, the strategic pricing, the marketing, the rise of completely new things like lab-grown diamonds, does knowing all that change how you perceive the value or maybe even the story behind that piece of jewelry you might buy?
Seeing the strategy behind the sparkle, that's definitely something to think about. Thanks for joining us for this deep dive.